Today we are going to learn some basic section of this program, that is to understand what is this contract of an insurance product. So to start off with, let me quickly take you through the agenda. First, we are going to understand what are the main features of a contract, and then types of a contract, and the definition of insurance contract, basic parts of an insurance contract, what is endorsements, what is deductibles, and what are other insurance provisions of a contract. So let's learn more about this. Features of a contract. What is a contract means? In a very simple context, contract is an agreement, enforceable law, an agreement, enforceable law. So in Sri Lanka, we follow the Roman Dutch law in terms of contract, where the detailed definition is an agreement between two or more parties to do or abstain from doing an act with the intention of creating a legal binding relationship. So therefore, to fulfill a contract, we are talking about some key features. The first one, offer and acceptance, competency to contract for the parties, the free consent, a law consideration, and a lawful subject. So what are these things? In a simple context, for you to sign an agreement, a contract, especially in terms of insurance, there should be an offer, a particular insurance subject. There should be an offer for an insurance policy, and then there should be an acceptance for that. So for an offer, there should be an acceptance from the insurer that they would like to insure this particular subject of insurance. And there should be a competency to both parties who are involving in the contract. Competencies can be in terms of age, in terms of capacity, and there should be a free consent. It is not a forceful consideration. It is a free consent between two parties. And a law of consideration and a lawful object. So as you know, when it comes to an insurance agreement, there is a law consideration. It will be a legal document, and also an insurance has to be for a lawful object. If it is illegal object, you cannot arrange a insurance policy. So it should be a lawful object. So these are some of the key features we can see in an insurance policy. And moreover, they say the contracts not always be in writing. So it can be in terms of written or verbal or even implied way. So that's, we talk about the common contracts. But sometimes we really need a written document. Now if you look at this case, a situation where you are buying or selling or even transferring or even mortgaging your land or any movable property or immovable property. In such situations, you need to have a contract signed in writing and it has to be in the presence of a licensed notary public with the 2 or more witnesses. So then it's going to be a legal document. So when you look at insurance policies, it has to be in written. So these are the key features that we see in an insurance policy. The contracts of record, judgments of the courts of law and other recognized tribunals. So the contract has to be recorded. And also contract under seal, a deed or a special contract. This is a contract which will be in writing and signed by both parties and is formally executed by the affixing a seal. So another key feature in terms of a policy where there is a seal, an official seal is imposed. And then there are even contracts on a verbal note in terms of conduct. But if you are talking about insurance policy, it is going to be specialized because of its nature. So such a contract must be in written form. So that's a key for insurance contract and how it's going to be differentiate from a common contract. So move on. An insurance contract has couple of sections or elements. So it's defined as whereby a person is consideration of a certain sum of money undertakes to make good the loss of another arising on the happening of an uncertain specialized event. I'm repeating, whereby a person is in a consideration of a certain sum of money. So there should be a person in consideration for a certain sum of money. So it has to be a financial value, undertakes to make a good the loss of another arising on the happening of an uncertain, specialized or specified event. So couple of key things that we need to highlight in this particular contract. Some of the examples we can say death, an accident, where we have dedicated insurance contracts. So some of the main elements that we see in a contract includes there is an insurer, there is an insured, there is a premium, there is a subject matter, there is an insurable interest, and there is a policy. So what are these elements are? Insurer, as we all know, it is the organization or the firm which is going to undertake or transfer that particular risk. We call the insurance company. Insured, the person whose loss is to be made good is called the insured, the policy holder, in other words. Premium, in other words, it is a consideration for which the insurer agrees to make good the loss. It is kind of the payment where the policy holder is going to pay to the insurance company in order to transfer this particular risk. That financial amount, that financial value we call the consideration as the premium. The next important thing is the subject matter. Every insurance contract has to be clearly mentioned the subject matter, the thing, the asset or the property or the belonging which is going to be insured. So this has to be very clear in the insurance policy, which is going to be insured. And also there should be an insurable interest. In other words, there's a financial interest which the insured has the subject matter. Has in the subject matter. So what is that insurable interest? There should be a insurable interest in order to sign this agreement. Let's say I want to sign an agreement, a life insurance policy. So I have an insurance interest over to that. I'm going to open a insurance policy for my vehicle. I have to have the insurable interest for that. It can be sometimes in terms of an ownership. I have the ownership of getting an insurance policy for that. I can take an insurance policy for my spouse. I can take an insurance policy for my particular asset. So such as where there should be a financial interest for that particular subject matter. And finally, there should be a policy which measures or which accounts or record all the details about the contract. So these are the main elements that we see in an insurance contract. Moreover, there are some sections that we need to understand. Couple of technical words that we see in an insurance contract. To start off with, declarations. So in an insurance contract, one of the key features we see is declarations. Declarations are the statements that provide information about the particular property or activity to be insured. In other words, it will show some of the key details of the contract. It's usually in the first page of the policy. Some of the key information includes the name of the insured, the location of the property, the period of protection, the amount of insurance, what is the insurance premium, what is the deductible information, what are the conditions, what are the endorsements, or what are the type of insurance risk which is going to cover, so and so forth. So therefore, it will give you very clearly what kind of insurance risk that you are exposed to. So all of them may be defined in the insurance contract. So a declaration would like to be expressed in this format, a sample, where as you can see of this particular example, the AIG company has given some information of an insurance declaration. So you can see in certain informations like name insured and the date of birth, the city and the zip codes where they are residing, maybe the coverages and the endorsements, what are the areas and what are the values, financial risk of each and every amounts, and the payments, the premiums that you are paying, and the underwriting values, and so forth. So this gives you a clear picture about the insurance policy. So this is a good example for you to understand the main declarations of an insurance contract. Moving on, the basic parts or the main sections that we see in an insurance contract. Apart from declaration, another section that we see is the exclusions. What do you mean by an exclusion? The word gives you an idea what is an exclusion. In other words, the things which are not going to be covered. In other words, things which are within the scope of this particular insurance policy. It is very important to mention it in the policy so that the people who are signing the contract clearly knows what is going to be insured, what is going to be excluded from insurance. Some of the key examples I have highlighted, such as excluded perils, the risk which is not going to be covered in this policy. For example, it can be riots, it can be an international act, It can be anything that is not going to be covered by that particular insurance policy. And also, it may specifically say some of the losses which are not going to be covered from that particular insurance contract. So from a homeowner's policy, it's clearly mentioned that the professional liability loss is excluded. Like that, we see in certain policies, clear excluded losses are highlighted. And also sometimes we see some of the excluded property. For example, if you take homeowners policy, some of the pets are not covered because it is not coming under that particular subject interest. If you take sometimes a cover, a home cover, an insurance protection cover, certain assets such as gold may not be covered. So there you have to clearly understand that if you lost from jewelry or something in terms of a insurance policy, you will not be able to claim for such damages. So like that, there are specific exclusions in insurance policies. Also, we see more and more exclusion policies, and it's important to understand the rationale behind it. Some of the main rationales of exclusions are, we know that some risk, perils cannot be insured. Some are beyond the scope, such as catastrophe due to a war or some incident, it cannot be insured. Sometimes if that particular subject matter is covered from another contract, it will not be covered in this particular contract. So it has to be clearly mentioned, such things. And also another key thing that we see is moral hazards. Especially to avoid moral hazards, organized the contracts are mentioning that giving limits for certain losses. So for example, coverage of money limit of $200 in homeowners policies, certain percentage of claims to avoid moral hazards. In other words, it will discourage a person to behave recklessly, thinking that the insurance will cover and they protect. So they know that there will be some penalty and a loss will be created, which will lead to behave properly and act accordingly. So exclusions are also needed for insurance contracts to safeguard this concept. Moreover, there we see conditions in insurance contracts. Now, what is a condition? In a simple context, condition is where it helps, or it a provision which limits some insurance to pay the premium or pay the claim. For example, if specific conditions are highlighted in a contract and at a given point the insured has not followed such conditions, there's a chance the insurance company is not paying the claim for that insurer. The insurer is not going to pay for the policyholder. So these can be very important to ensure that the insurance concept to maintain and insurance principle to follow. For example, it will clearly give the time that you need to recover your claims and when you are going to cancel the policy, the timelines, misstatements, the grace period, and some of the conditions that you need to fulfill at the time of signing the insurance policy. So if those conditions are not met, there's always the possibility the insurer to not to pay the claims at when the risk happens. Some of the examples would like to highlight how to report a loss, how long you have to report a loss, or how property will be valued, how and when a policy can be cancelled, when the insurer can non-renew the policy. Likewise, you see there are a lot of examples, conditions in the insurance policy. And also another key element that we see is endorsements and riders. Endorsement and riders are simply a set of new provisions or additions that we uh, connect to the insurance policy or remove from the insurance policy in terms of the scope and the risk. For example, uh, you can add a risk of an earthquake endorsement to the existing homeowners policy. You can add a new disease or a risk of a new health issue add to your existing health insurance policy. So therefore, it is a written provision that will add or modify the existing provisions of the contract with for an additional fee, and that will help the insurer to increase the scope of insurance policy and also for the insurance company to generate more revenue. And that is very important where we keep on adding endorsements with the understanding by two parties. And also we need to highlight in certain insurance policies there is a section on deductibles. What is a deductible? Deductible is where the insurance company, when they are claiming, when they are making the claims or payments, they do certain deductions. They deduct from the total pay that the total claim. And some of the main purposes are to safeguard some of the insurance policies and also eliminate the small claims that will handle in the process and also to reduce the moral hazards. Now, deductible means an amount is reduced from the insurance claim when they are settling a claim. And sometimes it has to be specifically mentioned at the policy so that there won't be any ambiguity later. For example, sometimes when you take an motor insurance policy, they specifically say when you met with an accident, the rubber items will not be giving the full percentage of cover. They'll be giving only a certain percentage from the value of the asset is paid. So one of the main reason that it's behind these deductibles are to manage the principles of indemnity. So in other words, it will avoid the policy holder to generate a profit from this claim. It will avoid to create people to be more reckless and careless and go for different behaviors where it will promote damages. So from a deductibles, they believe that the insurance, some of the principles can be maintained and it has to be specifically mentioned in the insurance policies. Also, when it comes to deductibles, we have different types of deductibles like straight deductibles and aggregate deductibles, and depending on the insurance policies we see different type of deductibles. Even examples like health insurance, we find couple of deductibles: a calendar year deductible, uh, a corridor deductible, and an elimination or waiting period. So these are some of the deductibles we see in health insurance policies, and there are more specific deductibles depending on the type of the insurance policy of organize of a of the two parties. Moving forward, when it comes to insurance, it depends sometimes on the value that you are going to claim. Now, sometimes you can insure for the full value, sometimes you can insure for the half a value, or maybe a certain percentage of the value of your asset. Now, if you take this particular example, here I've given a situation where we assuming there are 2000 buildings are there, and each building is valued at 200,000, where the total value of all the insured assets are going to be $400 million. This is about a fire insurance. However, at the end of the financial year, it was noted that there were two total losses of buildings, where we allocate $200,000 each into two of 400,000. And there are 30 partial losses at 20,000 each, which gives you a total loss of another 600,000. And the total fire losses is going to be then $1 million. However, we discussed there are going to be 400 million worth of buildings to be insured. So if we are to calculate the pure premium rate, we can see we are paying 25 cents per $100 of insurance. Now this is an example where the company is insuring for the full value of the asset. Let me take another example where the insurance is done for half a value of an asset. Now if you take this particular example, we talk about 2,000 buildings at a value each $200,000. But here we are trying to insure half of the value of the assets, which is going to be $200 million worth of assets. So each building, even though it values for 200,000, it is insured only for its half a value. So here we have again a situation where we have the two total losses, because insurer is going to pay only half of it. Now our cost is, the claim is going to be only 200,000. However, for partial losses, we are paying the 20,000 each, and that is going to be 600,000. So overall, the total fire losses is going to be $800,000. Now this is in a situation where if there is a full loss, the insurance company is going to pay only half of its value. Now when you take again the pure premium rate here, in this situation we take the total $800,000 divide by only $200 million, where it will calculate a 40 cents per $100 of insurance. 40 cents per $100 of insurance. So these are some of the examples for you to understand how an insurance claim is paid. One example where a situation, a company has insured a same asset in 3 insurance companies. Let's say a vehicle. A vehicle has been insured for 300,000 in the company insurance company A, and for another 100,000 in insurance company B, in another 100,000 for insurance company C. So as you can see, we have a total value of 500,000 for in 3 different insurance companies. So imagine there is a loss of 100,000 occurred. Let's say there was a loss of 100,000 occurred. Even though 100,000 loss occurred, sometimes you might think, okay, if you insured in 3 companies, we should be able to get 100,000 from each company. But if we are to get 100,000 from each company, we are going to receive $300,000 of total income. But actually you made a loss of 100,000. You made a loss of 100,000. So ideally you should receive a benefit of only 100,000. Irrespective of that, you insure in 3 or 5 or 10 insurance policies. This is actually following the insurance policy principles, because otherwise it will generate a profit for the policyholder. So in such situation, all 3 insurance companies will get together and make that 100,000 for the proportion that particular insurance policies are being calculated. So they total the total insurance policies, which is going to be 500,000, and the company A, which is insured for 300,000, will make the majority of the insurance claim of 60,000. And the company B, which they insured for 100,000, is pay only 20,000, and company C another 20,000. So you can see this 100,000 is contributed by all 3 companies, and it's not going to go beyond the total loss, which helps the company to make a profit, not to make a profit out of this insurance claim. These are some of the examples that I would like to highlight in insurance business when it comes to claim settlements. So we are going to discuss further in the next session, but just keep that in mind. An insurance policy have some key sections. So it would be great if you can take an insurance policy and see how these sections, how these elements are expressed in a real world policy to get a better idea about the insurance contract. So with that, I would like to conclude the session. Thank you very much for listening.